Nice.
Nice, cool. So, hello, today I have Chris Newhouse here. We're going to be talking about market making, trading in crypto. So, a bit of background, Chris is a great friend of the club. He has been a two-time speaker at the Cornell Blockchain Conference and is a crack trader. So, I'm glad to have him here.
Yeah, happy to be here, Max. Obviously I've been, speaking at the Cornell Blockchain Conference for I think 2 or 3 years now. You guys always run like a very solid conference. The conversations are always insightful and informative. So happy to do this, series with the club to talk a little bit more about, my career, what's been going on in the markets, and anything relevant to that.
Nice, great. So, let's dive in. So your background has been from Genesis to GSR to the Chicago Trading Company to Cumberland, Ergonia. You went from crypto trading companies to CTC, a traditional firm, and back to crypto. Why the switch? And what in crypto compels you to switch back?
Yeah, happy to answer that. I initially started my career over at Genesis. I was an engineer on the derivatives trading desk with Josh Lim. Ended up, wrapping that up. I did like a market insights and analyst role. Is more research focused under Noel Aitchison while I finished up my degree. Ended up getting a couple of different offers. So I had an offer from Genesis, offer from GSR, and an offer from Acuna Capital, all as a crypto options trader. So for me, it was a little bit more, okay, what did I want my first opportunity out of college to look like? And for me, Genesis was heavily institutional. Acuna Capital, in terms of what they were doing at the time, was purely just crypto as a trading, firm, just trading a different asset. Whereas, GSR was a little bit more focused on the market making business. And so market makers obviously have a massive amount of exposure to various projects, protocols. They speak with founders. They potentially invest on the venture side. They have an OTC trading desk. And so for me, I ended up choosing GSR as the first place to start my career. I was an OTC trader over there. I quoted altcoin vol. I did some prop trading. I've worked with some of the business development team in terms of structuring token market making deals, loan call option. We'll talk a little bit more about that later. But essentially stayed there for about a year before I ended up, leaving, going back to school. I was pursuing a master's degree from Georgia Tech in quantitative and computational finance. I ended up leaving GSR because there was a massive amount of volatility. So it was kind of right after FTX blew up, right when Silicon Valley Bank blew up, right when USDC depegged. And so for me, I was getting married the next year and wanted to understand where I was going to be for the next year. And so decided to go back to college, pursued a master's degree there. I was there for about 4 or 5 months before the Bitcoin ETFs were approved. So the BlackRock IBIT ETF was approved, and I was kind of, sitting on my hands thinking a lot of the opportunities that I would have, after the master's degree were going to be the same as the ones that I was potentially looking at while I was still in the program. And so I decided to take a quick gap semester to go to Cumberland Labs. So Cumberland Labs was a venture studio and incubator by, the partners at Cumberland and DRW. We built Hashnote, we built Expand. Both of those were acquired. We co-led the round and incubated Purple Trade. And so we were doing a massive amount of building things. We are cooking up a couple of new things as well. One of them is a Solana Perp Dex, and then another thing is a Bitcoin, yield and asset management platform for institutions. And so I spent 6 months there. I transitioned obviously from trader to a little bit more on the research and venture side. While I was there, I wrapped up the 6 month contractor position and, had an opportunity to go be a quant trader at Chicago Trading Company. So it was kind of like, quantitative trading is probably one of the most difficult careers to break into. And so for me, it was kind of like, okay, if I have this offer in hand, like I have to go take it. Like I have to see, I didn't want to be potentially, having any second thoughts or having that what if, right? Like if I didn't accept this offer, well, man, I could have been what if I was a good trader, right? And so for me, it was a little bit like, okay, let me go try. And so I was on the desk over at Chicago Trading Company for 51 days. I was a quant trader on the natural gas desk. And, I got into the obviously TradFi trading industry and thought, wow, this is really boring. I didn't want to, make two tick wide markets around natural gas for the rest of my life. And so, I pinged my old boss, Tama, he's the CEO of Cumberland Labs. I was kind of like, dude, like, please let me come back. And, 24 hours later, I had an offer in hand and ended up leaving CTC to come back to Cumberland Labs. This time I was a little bit more directly involved with some of the venture stuff. And then obviously now, I transitioned over to Ergonia. So Ergonia, we're an on-chain trading team. We specialize massively in Solana. We were one of the most active addresses by transaction count last year. We have co-built a lot of different things in the space. We'll talk about this later in the interview, but we have built out kind of these, the dark AMM, prop AMM, Oracle inventory AMM. We'll talk about this a little bit later, but we've built some of those out, integrated directly with routers, integrated directly with aggregators. And yeah, I lead business development, venture, strategy, et cetera, et cetera. So anything that is not active trading is something that I have my hands tied up with now. And so, we're an on-chain market maker. We do prop trading. We do a massive amount of discretionary DeFi stuff, TBL deals. And so looking forward to sharing with you guys a little bit more about, the dark forest of market making, as well as some of the interesting, trading technology and market microstructure that is out there right now.
Yeah, like it's funny because most people I know in crypto who went to the master's program, they want to, like structure their life traditionally, but they all end up dropping out because crypto is too interesting and moves too quickly. So you just gotta be ahead of the market.
Exactly.
Nice. And you mentioned that you switched from, market making trading role to more of a BD venture role. Like why the switch? And like are there some transferable skills between both of them?
Yes. So from my perspective, obviously the biggest thing in crypto that has product market fit is a lot of DeFi. So you see a massive amount of stable coins, trading venues, just a lot of different things with decentralized finance. And so obviously these on the underlying, thing that's going on in terms of the infrastructure, the tech, things like that, it has something to do with finance, right? And so obviously coming from a quantitative trading background, I had studied, Black-Scholes, I had studied stochastic calculus, the whole nine yards, C++. I was previously obviously a trader at GSR as well. And so a lot of the skills and a lot of the things that I learned in terms of a quantitative mindset and being able to think about complex problems and get down to brass tacks and solve them came from that quantitative trading background, that quantitative finance masters. And is something that I'm able to directly apply to, business development and venture. Whenever I'm analyzing a lot of the deals, a lot of things get very technical very quickly, right? Obviously, I don't really have a developer background, but the products that these people are building are typically going to be doing something with financial products. And having the background, and one of the most complex ones, options, really gave me like a really great bird's eye view of what a holistic financial landscape looks like in terms of, okay, this is how the products work together. I'm familiar with exchanges. I'm familiar with options. I'm familiar with what yield looks like. I'm familiar with a lot of different things. I've priced options. I've looked at a lot of stuff, and that kind of gives me like the overarching mindset and landscape to look at some of these investments, from that lens. A lot of people look at it from only a business lens. I'm looking at, I look at it from a business lens as well, but also kind of like the underlying mechanism for how the product works. And since it is in finance, that definitely helps. Also, kind of, it's very, very, very rare actually that you see business development or venture move to trading. Whereas with trading, you can be a good trader, you could be a bad trader, but you could still move into venture and business development. Venture and business development, the skill set is very different. The skill set might be relatively complementary in terms of the stuff that I did on the trading side before I moved over to VC and BD. Obviously, whenever I hop into calls with founders, one of the biggest, you can see on their eyes, they kind of light up whenever they see previous quantitative trader or someone in the financial industry, because it's not just someone who has, a sales background or a product background. It's someone who really does understand exactly what the founder is building, exactly what the founders are building. And so for me, a lot of the questions that I ask are typically, the ones that they like answering. It's not necessarily like, oh, win token. It's a little bit more like, wow, what are you building? Like, this is super interesting. From a hedging perspective, here's how we would use this. Here's how we would think about this product. Here's how we would think about go to market if you're building a trading protocol. And so for us, the skills that I learned as a quantitative trader, as well as the stuff that I learned in my master's degree, is actually very applicable. Yeah. So I ended up moving over as well, just because a lot of my strengths necessarily were a little bit more on the people, the understanding, the business, strategy, go to market. A lot of my strengths were there. And so for me, just thinking about not necessarily my first career, but what I want in my mid-level career is like pick something that I'm good at. And so I was just incredibly fortunate that the thing that I'm good at is also something that I love to do. And so that is a little bit of like career advice there, I'd say.
Yeah, interesting. Yeah, because I would say like for me, although like I'm a CS major, but I also figured out, BD, VC strategy is also like one of my strengths here. So yeah, like that's very inspiring.
Yeah, and I mean, you look at a lot of the people, I'd say that actually the strongest researchers and analysts don't necessarily come with a degree in finance. It's more so a degree in computer science or math, because this is kind of like the underlying, languages and infrastructure and complex levels of thinking that kind of go into some of these products and primitives. Obviously, like I said, DeFi is a massive narrative in crypto, and it's one of the biggest things that has product market fit right now. So obviously, DeFi, you see a lot of people with these technical backgrounds building these products, and so it's very nice to be able to actually understand what they're programming and what they're coding and what the smart contracts look like for sure.
Yeah, that's true. That's true. Yeah, like maybe, CS majors instead of trying to grind lead code, like maybe this is another career path you can take, leverage your technical skills
There you go.
in product, BD, VC. Nice, nice. Great. Yeah, let's move on Cumberland right now. Like how does the crypto market making firm like Cumberland develop their edge? Do you think it's more on the strategy side or is it the infrastructure side?
Yeah, so it really depends on how you look at it. Obviously, so I'm at Ergonia. This is the on-chain trading arm out of Cumberland. Cumberland is more of the CeFi market maker. It also depends on how you define market making. So if you're market making for prop trading and alpha, and that's kind of what you're doing. Obviously, a lot of those strategies, like there's a lot of data analysis, there's a lot of alternative data sources, there's a lot of co-location and infrastructure things that come into play in terms of like developing a strategy, developing an edge. It also depends on the different asset classes. There are a lot of inefficiencies in the digital asset markets as well. And that's something that a lot of traditional players in the space have definitely taken note of. In terms of the on-chain trading space on market making, it's actually very, very interesting that you bring that up. You're actually typically confined to, potentially the blockchain or the L1 or the L2 that you're actively trading on, right? And so one of the most interesting things for us at Argonia in terms of like the Solana market microstructure and the landscape here, something I would say is that Solana is a layer one in which a deep understanding of the technical architecture and the implementation of a lot of the different, not Solidity, Rust and smart contract and programming languages. It actually gives you a massive advantage in on-chain trading. And so for us, in terms of developing an edge, it's very much so developer heavy. There's a lot of arbitrages. There's a lot of opportunities to just be a little bit more efficient in your smart contract, development. The way that Solana kind of works with the scheduler and transactions and things like that, like being very, very efficient in writing, some of the lowest compute unit contracts on Solana, like that gives you a massive edge. And we'll talk about it a little bit later, but there are kind of like these, prop AMMs or Oracle inventory AMMs or these kind of like vault-based liquidity, programs that have been built by in-house trading teams and things like that. That actually take advantage of a massive amount of Solana's architecture to provide tighter quotes than some of the, lit AMMs in terms of like, Radium, Meteora, Orca, et cetera. I think, there's a great research post that was just put out very recently, I think by Delphi. And they put out, I think it's like what, in 2025, as of July 18th, 40% of Jupiter's flow goes through these prop AMMs. And so, yeah, we'll definitely talk about that a little bit later, but, that is kind of how you develop an edge in crypto. It's a combination of developer knowledge, architecture. It depends on if it's CeFi or if it's DeFi. It depends on the asset class you're trading. Obviously, for crypto, like things are very inefficient. There's a lot of arbitrage opportunities. There's a product that's not available in traditional finance, right? The perpetual future, and that adds just an entire another dimension of what you can think about in terms of creating strategies.
I see. Yeah, like speaking of prop AMMs, actually let's dive deeper into prop AMMs because I'm very interested in the area as well. So, like prop AMMs like SolFi, O-Breaker quoting more competitive prices to Jupiter aggregator, as you said. So like, do you mind walking me through like what are these prop AMMs? How do they work and how do they differ from the central limit order books or other traditional AMMs?
Yeah, so I mean, one of the biggest differences here is, I can go through and walk through a couple of different differences in terms of like how they compare to plot-based liquidity, AMM-based liquidity, et cetera. And so these kind of prop AMMs, you can call them many different things. I think on Twitter, some people call them dark AMMs. I don't really like that just because it gets confused very quickly with dark pools, which these really aren't. Essentially, these are kind of like Solana programs that are, vault-based liquidity. They can selectively be quoting because they're directly, going through an aggregator. They don't really have a front end. They're incredibly capital efficient in terms of kind of like, if you look at a metric of something like volume over TVL, TVL. So in a traditional AMM, there's usually a massive amount of TVL because like users are providing liquidity into a pool, XY equals K. For these, it is vault-based liquidity. It is Oracle pricing. It is, selective quoting. It is directly plugged into an aggregator with no front end. And so what that allows us to do is a lot of different things. I mean, selective quoting for one, is massively impactful. Like these are really designed to protect market makers. At the core, like obviously with AMMs, you're very familiar with impermanent loss and loss versus rebalancing. Like that's something that we obviously don't have to face because one, we're selectively quoting. Two, it's not like, passive liquidity that always sits there. We're literally choosing the exact, bid offer spread that we want to trade at, be hedged at. All these transactions are atomic. They either go through or they don't. And so for us, that is definitely like a very much so. This evolved over the past couple of years. It's popped up recently in the past couple of months. But this is something that is, relatively new. And this is something that's massively beneficial for a lot of the high frequency trading firms and market makers out there. Yeah. And so in terms of like what they are, I kind of, went through 4 or 5 different things. There's no front end. It's vol-based liquidity. They're incredibly efficient in terms of volume over TVL, powered by Oracle and the market maker's inventory. It's not an XY equals K thing. There's no bonding curves. But these are kind of just like the next iteration of trading technology that's been built out on Solana specifically, just because like the way that these, work and depend on the underlying architecture is actually very, very heavy. And so this is not something that's on Ethereum, right? And so even in terms of the EVM landscape, it's just not something you see. I mean, even whenever you think about EVM and some of the stuff that goes on dexes, like sure there are aggregators, but a lot of people were mainly trading through the front ends. And so obviously on Solana, like the market microstructure is a little bit different, and having that kind of market microstructure in which a massive amount of flow goes through aggregators has actually driven the microstructure to shift a little bit more towards facilitating some of these Oracle inventory AMMs in terms of kind of like the ability for market makers to quote incredibly tightly. Yeah.
I see. Yeah, like I guess one thing that always confused me is like when we're looking at prop AMMs and conventional market makers, what exactly is the difference? Because we can compare vaults with conventional market makers inventory, and both of them are quoting like prop prices for like the aggregator or the market. So like what exactly is the difference between a conventional market maker and a prop AMM? And like if they're quoting selective prices, like can you even call them AMMs?
Well, I mean, I guess you'd have to maybe reword the question there. You're kind of asking what's the difference between a trading tool that a market maker uses and a market maker, which one's a tool and the
Oh,
other's kind of like a description of a firm that posts two-sided liquidity.
oh, okay. So like I guess what I'm asking is, um, like why is this tech called AMMs? Yeah, I guess like that's the first
I guess
question.
it's not necessarily like AMM. I've also
Yeah.
heard it called prop dex, some sort of like Oracle inventory market maker. I've heard it called, the dark AMMs. I guess it's mainly just because like the ability, like it looks very similar in terms of like, okay, you trade against a front, like the end result's the same. Like you go through Jupiter, you click a button, you trade some Sol USDC, and it's like very similar to the same stuff you do on like Radium or Meteor or something like that. But essentially, it looks the same, but it's not the same, right? There's no XY equals K. You're usually getting a tighter price than, Orca or some of these other AMMs and things like that. So yeah, that's kind of what I would say.
I see, I see. And you also mentioned that these prop AMMs are exclusive to Solana due to Solana's microstructure. Do you mind elaborating a bit on that? Yeah, if you're.
Yeah. So obviously on the Solana blockchain ecosystem, like a massive amount of, both retail flow as well as API quotes and things like that go through aggregators. So Jupiter is obviously one of the larger ones. Titan's another one that's come out. There's like DFlow, OKX. But Solana is kind of like one of the chains where aggregators dominate a lot of the flow, especially on the front end. And so like knowing that as well as kind of the underlying architecture of Solana in terms of, fast block times, low fees, the way that the scheduler prioritizes transactions, as well as how the interactions between just-in-time liquidity and being able to provide these quotes to Jupiter actually works. It's facilitated like this innovation in terms of like what these prop dexes look like in terms of like what these quotes look like. And then also kind of like, yeah, I mean, some of these specialize in certain pairs, like these are incredibly compute unit efficient contracts. And so it really depends on kind of like the underlying architecture for sure.
See, like, do you think this architecture or like this prop AMM phenomenon is healthy for Solana in the long term? Because I think what Solana wants to do is on-chain price discovery, right? But if we're relying on this Oracle-based,
Mm-hmm.
prices from centralized exchange with higher liquidity, we're essentially like lagging behind, but like we're just minimizing the time lag between SECs and DEXs. So like I guess long term, do you think this will be a thing, or like do you think this is useful for the Solana ecosystem?
Yeah, I mean, I guess from my personal perspective, it's like, what do you classify success as? And if you're categorizing success as, fully transparent on-chain price discovery through a central limit order book, okay, maybe this is probably not, indicative of success. But if you classify success as end user using your protocol gets tighter fills, does it for cheaper, and is able to trade better, then yeah, this looks like success. And so from my perspective, it's kind of like, what are you thinking about and what are you prioritizing in terms of, creating some of these metrics for on-chain success? Like for me, I mean, like I'm happy to trade something cheaper, faster, better. Necessarily like, okay, in terms of, looking at a central limit order book and making sure that we have, transparent on-chain price discovery through some sort of like order book model that's analogous to traditional finance, like that would be great and cool, but I care a little bit more about like what I'm getting filled at. If I'm able to trade back and forth, if liquidity is deep. So for me, like you could definitely have both. But yeah, if you're looking at it in terms of like having to choose one or the other, it's really what you define success as.
Yeah, it's fair. It's fair. Yeah, like one thing I learned over the years is like success is an arbitrary thing, like people have different definitions of it. So yeah, like people take different steps towards it. Yeah, so speaking of clubs, Paradigm has invested in a lot of on-chain clubs. It is clear that they believe that is the future of capital markets, and they believe that it will exist on-chain. So, like different clubs take different design choices to protect different stakeholders. So what are your thoughts on current club designs? And do you mind listing the pros and cons of each design?
Yeah. Obviously you have kind of like, do you want the choice of some high throughput layer two, or my bad, high throughput, low latency layer ones? Do you want to, build on the security of the parent chain and go for a layer two that, is able to, transact quicker with lower fees and things like that, but then you risk centralization, due to the centralized sequencers and things like that. You have kind of like obviously some of the mechanisms that people do this in terms of, off-chain order book, on-chain matching. And so there's a lot of different kind of like ways to look at it. There's many different ways to skin the cat here in terms of like also, whenever you're thinking about club design, like it really does at the first, initial thought come down to what the L1 you're building on is capable of, right? And so like there's clubs on every single L1. It is like a core piece of infrastructure in terms of like, okay, typically you have some sort of perp dex, you have some sort of spot AMM liquidity, you have a lending and borrowing market. Potentially you got like some LSTs and things like that. But being able to have like a central limit order book in terms of a perp exchange, like that is potentially like I would say a core piece of infrastructure across any chain. And so whenever you're thinking about it from that perspective, like the first thing I would do in terms of looking at what's going on is understanding, are you building on an L1? Are you building on an L2? And then obviously some of the trade-offs that come with that, like, if the L1's not fast enough, then it's probably going through L2. If you're doing it on an L2, like there's centralized sequencers and publishing data back to the main chain, concerns like that. And so it really comes down to like, okay, what are you willing to give up and trade off and things like that previously to probably 2024, 2025. Obviously now like there are, high throughput chains with low fees that could potentially get like clubs on chain fully. There are, novel mechanisms and innovations that people like Drift are taking in terms of just-in-time liquidity and being able to actually integrate some of those like routes into these prop AMMs directly. And so there's a bunch of different things that are going on over the next couple of years that I think are going to continue to make, the central limit order book, something super interesting for people to continue to look at. Whether or not there's like some, Oracle inventory Oracle inventory, AMM, just-in-time liquidity on the back end, filling some of these quotes, or if it really is just a market maker posting two-way bid-ask spreads. That's kind of my thought on the CLOB landscape right now is, what has been great for the past 20, 30, 40 years obviously might have some architectural improvements or even some structural improvements in terms of the market heading forward, especially with some of the trends that we're seeing on Solana.
I see. Like, do you think clubs is a winner takes all situation? Because if the goal is to bring capital markets on chain, it makes sense, for the place with the most liquidity to be traded, like for like tokenized equities, etc. Right? But like what we're seeing now is like 10 different chains making 10 different clubs on them, and like saying that they are the future of on-chain capital markets. Like, sure, if there's other activity happening on your chain and your club is trading on those activity, it makes sense. But like if the layer one or like the infrastructure is made just for on-chain clubs, like it's kind of dangerous, right? So I guess what are your thoughts on that? Like, do you think it's a winner takes all, or do you think like, different clubs, different designs will cater to like different people so they will survive?
Yeah, I mean, I don't think it's necessarily a winner takes all. I think it's a couple winners take all. In terms of like, there could also be specialization across some of these different kind of dexes and order books, right? Like you see some. I think Ostium's a good example of like RWA stuff and things like that. Being able to trade that through a central limit order book or and stuff like that. And so yeah, I think that there will be a couple that end up winning. But I do think it'll be specifically on certain chains. Like it could be, obviously Hyperliquid is killing it, and then there's obviously stuff going on in Solana, and then potentially Monad, but Monad hasn't launched yet, and all of this stuff. So yeah, I don't think it's necessarily a one winner is going to take all, because also like currently in this state, there's use cases for several different blockchains. You have some that specialize in gaming and some that specialize in, content creation and community focused and stuff like that. You have other things that specialize in trading. And so from my perspective, it's not necessarily winner takes all, but it's like, what is going to be the most interesting chain to be able to perform like these high throughput transactions with low fees? That's probably where, most of the club activity is going to be concentrated. That's where a lot of the traders are going to be. So you see them all on Hyperliquid and Solana and stuff like that. Yeah.
I see, I see. Yeah, let's zoom out, talk a bit about market making. Um, can you tell us like what are the main revenue streams of market making firms like Cumberland?
Yeah, I mean, it depends on how you categorize that as well. Like obviously, if you're market making just prop trading wise, it's the bid ask spread, right? Like you're going to buy on the bid, sell on the offer. If you're talking about it from the deals that everyone talks about in terms of like the loan call option or the retainer and stuff like that founders like to think about, then it really depends on kind of like the market maker you're partnering with. There are obviously predatory market makers out there who end up dumping the loan, trying to repay it back for as low as possible. You have people like us who are specifically trying to monetize the option. The good market makers in the space, that's how they actually usually act, in terms of like, hey, the option has value. We're just monetizing the option in terms of being able to scalp the gamma back and forth. And so, yeah, we're able to post two-sided liquidity, meet KPIs, things like that. It really depends. I mean, there's obviously the trader first shops, in which like prop trading is their main source of revenue. And then there's kind of like the BD heavy shops where these token market making deals with founders that are being paid out in loan call option are some of the ways to generate revenue as well. And so that's how I think of it.
Nice. Yeah, it's great that you mentioned, how MM deals are structured. So let's dive deeper into it. So yeah, like, can you walk me through what a market making deal looks like? What are some nuances, BD or projects to be aware of when structuring a market making deal with a market maker?
Yeah, obviously from my perspective, it's pretty unique. I used to be a trader. I used to price these deals. I've been a BD, so I've now pitched these deals. I've been an advisor to several protocols, so I've advised them on how not to get screwed. So, I've kind of got the trifecta in terms of experience of looking at some of these deals. The way that a lot of these deals are structured, it's either going to be a loan of the project's token with an embedded call option, which allows you to either repay the loan in kind with the token, or to repay them a set amount of USD, which is typically at predetermined strike prices, that the market maker comes up with. And so what these deals kind of look like, especially on the loan call option, that's one that's obviously like very prevalent, very popular. That's also the most like controversial one. And I'll tell you why that's like, potentially controversial, but also like the most interesting. So like projects are typically token rich and cash poor, right? But market making is a service that a lot of people need. You need to have the liquidity two-sided to buy and sell your token. There's obviously the analogy to where, everyone says like, the iPhones and stuff like that. And so I'll give the same analogy, right? If the price of Apple stock goes up or down, you can still use your iPhone. If the price of your layer one token goes up or down, like that definitely impacts the user experience of your layer one in terms of fees and the ability to use the decentralized applications that are built on top of that blockchain. And so market making is an essential service that many different firms, Cumberland included, provide. And so it is a necessary thing. And so from my perspective as well, we can go into a little bit more of what the structure of these deals look like. I kind of told you it's the loan call option. Obviously, there are many different things that you can do. You can make the strikes super out of the money. You can make them more in the money. You can increase the size of the loan. You can decrease the size of the loan. You can structure the call options to start, staggered at different times. You can change like how the strike works in terms of like, okay, is it a TWAP over 7 days? Is it a VWAP over 7 days? Is it a TWAP over 14 days? Okay, if you're TWAPing it over 7 days, when are you doing it? Are you doing it at every hour? Are you doing it at every 0000 UTC? Like there's multiple different things that you can think about in terms of how to structure these deals. But obviously, like one of the most interesting, things about it is like the option structure and being essentially all these parameters change the value of an option. And so at the end of the day, like the way the market maker is monetizing these, if they're like a good actor, is through the value of the option, right? Like they're just buying on the bid, selling on the offer. They're positive gamma by being long these options. And so whenever you're long gamma, you essentially are able to, okay, buy low, sell high. And they're doing that, which also provides natural two-sided liquidity to your token. When the token's going down, they're buying. When the token's going up, they're selling. It's natural two-sided liquidity, right? And so that's something that's definitely interesting about the structure. Yeah, kind of ran through like so many different things you can change. You can change the loan. Like, I already ran through all of that. But yeah, I mean the reason why like people have thought it to be predatory previously is because like obviously in the bull markets of the ICO era and 2021 and 2020 DeFi summer, things like that. Like people were giving up, 1, 2, 3, 4, 5, 10% of their token with some of these call options embedded at like 200% out of the money. And then the token TGEs and launches and goes up 100x. And so the option value ends up going from like, 500K on TGE to like 50 million. And you gave a loan and you also gave them an embedded call option. And now your call option is in the money and they're going to call you on it. And so that was kind of like, people see that, oh my God, I just gave up 50 mil because I gave a 5% loan out and the token went crazy. But they don't really ever talk about, oh my God, what if my token went to zero? Well, then the market maker just provided the services that I need for free. And I got my token back. And so that's something that people don't really think about. They only see like, oh my gosh, I gave up all the upside, but they don't also see the, inherent risk of, okay, what if the token does nothing? What if the token goes to zero? And so, yeah, it makes sense as to why this is a structure.
I see. Yeah, there's a lot of things to digest there. Interesting. So like I guess to reiterate what you're saying, like the loan and call option structure is, um, the project gives a loan to the market maker in kind, right? So like the market maker will like use these tokens to like market make.
To provide offer side liquidity. And then
Yep.
the market maker is on the hook typically to provide the bid side USDC that usually is the quote asset. Yes. And because, right, like to be able to
Right.
provide the offer, I need the token, right? I need some
Right.
spot token at some point. So we do need token somehow. Yeah.
Okay, yeah, that makes a lot of sense. Interesting. I guess like I mean you mentioned like the deal structure. Like can you give me two scenarios? Like the first scenario is like what is a deal that is very attractive to a market maker but not attractive to the project? And what is a deal that is really attractive to a project but not attractive to a market maker?
I mean, it really depends on the size of the loan. Obviously, like the more loan that the market maker can get, first of all, it gives them the opportunity to have like more liquidity they can post for the project. So it could be mutually beneficial if that's how they're using the loan. Something to be on the lookout for is market makers who don't necessarily use all of the loan, and why do they need it then, right? Like they're just getting extra optionality. But also like trading does have a cost, and so if they're really bad at trading, then obviously they're trying to make P&L somehow. And so they're doing it through these deals. And so, yeah, I mean, I guess in terms of like, the most favorable one for market makers is going to be whatever has, the highest loan with the most in the money strikes, because then you can just call the options relatively quickly. And the ones that are super favorable for projects is like giving away little loan, but like there needs to be a proper balance, right? Because if you're not able to give out enough loan to provide like that offer side liquidity, like you don't really get the depth or the KPIs being met for someone to actually trade your token. So there is like some sort of sweet spot or middle zone of how much loan of token you should be giving out to be able to provide that liquidity.
Interesting. Yeah, because I also heard, like, I'm not going to name names, but there are some market makers that, do the structure and they artificially pump the price up to the strike price. So, like, they're in the money and they'll call the option.
That would probably get into the legalese of the contract.
Right.
Typically, I believe these are kind of like European style options to where you can't call them in the middle of the deal. Because, yeah, that seems pretty predatory to pump the price and then, yeah, keep that. So, yeah, I mean, it typically depends on the legalese in the contract in terms of how these are paid. But most of them typically are European and you do this exercising at the end.
I see, I see. Like, I mean, since you have been on like all sides of market making, like, do you ever see this process coming on chain anytime soon?
What do you mean on chain? Like
Like everything trading related.
I mean, I guess there are a couple of firms who try to do on-chain market making and things like that. But I mean, at the end of the day, like high frequency trading is not easy. And so you don't want to be giving like idiots a bunch of your token and giving them the opportunity to play around with your price, right? Like, so from my perspective, like, the best market makers are typically the best traders as well. And so obviously DRW, coming from the high frequency trading background since 1992, we are really good traders. And we end up providing like market making as a service. It's, our core business is prop trading and high frequency trading. And we actually do think of this purely as a service. So we're here to meet KPIs. We're here to be amenable to the projects, not out to screw anyone. Obviously, I'm sure every single market maker will say that, but we kind of have the track record of being good at trading to back that up in terms of our claims.
True, true. Nice. Yeah. Let's zoom out a bit on like talk about your BD VC side. So like can you share with us like what is your thesis on a crypto trading landscape and where in the stack you have high conviction bets on?
Yeah. So for me, I mean, a lot of the trading landscape that I'm looking at is obviously going to be in a lot of these cloud dexes, the stuff that is building on-chain trading tooling and data. And so for me, I mean, the most interesting, I come from a trading background. I look at DeFi all day. For me, I just like stuff that makes DeFi more efficient, makes it more user friendly, makes it more interesting for people to get involved with, add some sort of like gamification, some sort of layer that brings the consumer on chain as well. And so for me, I mean, the most interesting thing is definitely the trading and the trading tooling, whether that is on the data side, whether that is on the exchange side. And so, yeah, I think my thesis aligns very much so with my strengths, with our firm's strengths, and also one of the more interesting narratives that has popped up, which is like these clubs and private AMMs and things like that.
I see. Yeah. I want to dive deeper into that as in like, VC invest in okay, so like VC sees a problem and invest in people who solves it, right? So like do you mind listing a few specific problems that you see exist in a stack? And if anyone is building to solve that problem, you would like, yeah, I'll give you my money. Any
Yeah,
examples?
honestly, I don't have any. Like, I mean, a lot of the stuff that I want to be solved is either already solved or already funded. In terms of
Right.
if if we could think of a novel problem to solve, we'd just incubate it and do it ourselves. So, I mean, from our perspective, we are cooking up a couple of things. I guess some people are attempting to solve things, but they're just not doing it well, and so like that's something to think about. I mean, yeah, nothing too crazy pops up in the top of my mind. So.
Okay, yeah, it's fair, it's fair. Yeah, I mean, like that's a secret sauce for every VC, so
Yeah.
that makes sense. Nice. Well, actually, like before we end, there's this topic that I just thought of, tokenized stock. Like, do you have any thoughts on it?
Yeah, I mean, it is super interesting. Obviously, it gives you the ability to be composable on DeFi. It gives you the 24/7 market access. It helps for transparent price discovery. But it really does depend on like the liquidity that market makers are able to come in and provide, right? Like if nobody's going to quote them on the weekend, then what's the benefit of being open 24/7? A lot of this stuff also comes down to hedging. And so, like, it potentially could be interesting to have tokenized stocks to hedge weekend activity and weekend moves. But then again, you need the market makers to provide the other side of the trade, right? And so, like, a lot of this stuff really is going to be a liquidity flywheel in terms of being able to like bootstrap liquidity, incentivize market makers to come in and trade some of this stuff, giving them the opportunity to hedge things. And so, yeah, tokenized stocks is definitely something that's super interesting. I mean, you're seeing it for like, there's always the pre TGE like token perps and stuff like that on Hyperliquid. And I'm pretty sure what Robinhood did the tokenized Open AI, and what's the other one that they did? Yeah,
SpaceX.
SpaceX.
Yeah,
Yeah. And so that is just something that is kind of interesting. But yeah, it's definitely an interesting narrative, but it really is going to depend on who gets active on the market making side there.
yeah, that's true. Yeah, because like I was on crypto Twitter, of course, and like there are a few people saying that like these tokenized stocks are like low float, high FTV equivalents because like stock market Nasdaq has way more liquidity than this like tokenized thing. So like you have to balance the information and symmetry of
Yes.
both. It's kind of hard. And also there is this concern of insider trading, right? Because if like I mean the ideal of tokenized stock is everyone can access US capital markets, right? But like if everyone can access it, like then the congressman, everyone can trade it like anonymously, right? So I guess like on that front, yeah, what are like do you have like particular thoughts on like insider trading or like do you think it's a bit
No
of a reality?
thoughts other
No
than
thoughts.
it's bad.
Yeah, I'm trying to bait you into something. But yeah, yeah. And another thing is like, do you think tokenized stocks is going to, be a thing behind walled gardens, or do you think it's going to be permissionless? Because my thoughts are, if it is behind walled gardens, then all these DeFi protocols that Aave, et cetera, like that are developed for this moment, right? Like for this particular moment will like
I see what you're getting
yeah,
at.
it's not ideal.
I mean, from my perspective, it's kind of like, okay, I mean, what do you want to prioritize? Do you want full trustless decentralization, or do you just want better markets? Like, do you want to be able to trade stocks 24/7? Do you want to be able to have composability on DeFi? And so obviously, like a lot of the stuff that initially happened with Hyperliquid in terms of like the concerns of centralization and only having four validators and all of that, like people didn't really care because it was just a really good product with a lot of deep liquidity and great incentives. And so, I mean, I would encourage you to think about what you care about. Staying decentralized and kind of filling the ethos of crypto for me actually probably comes second to having better fills, 24/7 market access and liquidity, composability on DeFi, the ability to generate yields. And so like there's a bunch of different things that blockchain technology enables that doesn't necessarily potentially fill up to the ethos of crypto as a whole, in terms of that decentralization aspect. So, I mean, that's something to think about in terms of what you're prioritizing whenever you're actively getting on chain and doing something.
Yeah, it's fair. It's fair. Yeah, because I don't know, like, I just feel like a lot of questions are posed from tokenized stocks because if it is a walled garden, then insider trading will be pretty good, like pretty regulated because like who's trading, but at the same time, like oh, create difficulties for DeFi protocols to participate in this boom. But yeah, okay, yeah, that's a valid take. Nice. Let's wrap up then. Yeah. So last question is, what advice would you give someone who would like to follow your footsteps of being a trader and be a BD and venture capitalist in crypto?
Yeah, so my path is pretty difficult to replicate. I got in at the right place at the right time with the right skills, and the right people took the right bets on me and gave me the opportunities that I had. So a lot of it was, a combination of just luck and being with the right people. But my advice for people who are looking to get into the space career wise now, do as much as you can. Come in with the research. Write something. Put your thoughts out there publicly. That's something that is definitely super interesting. Being able to see written content, being able to see how you think. That's something that can differentiate one candidate from another. Once you get some of these like internships, like once your foot is in the door at the right places, there actually really is a snowball effect because the internships are so difficult to get. I know a lot of this stuff has like single digit amount of students who are able to get these internships, and so that's something to where it snowballs. And if you are able to do some of this as a freshman or as a sophomore, keep your foot on the gas, because that is how you end up at some of the best places after you graduate. So yeah, I mean, a lot of my advice centers around just putting in extra work and being well networked, being well connected, and then trying to get in as early as possible, right? Like the best time to get in was probably a year ago, but now, the second best time is now. And so obviously as well, like from a career risk standpoint, that is something that prevented a lot of students from being interested in 2017, 2020, 2022. Like I really do think that the career risk of going into crypto now is very low. You see so many different traditional institutions, entering the foray. You see a lot of different things on, roles in product and growth and strategy and FP&A at exchanges and different trading firms and protocols and software engineering, roles. There's so many different things to do in crypto to where those skills are actually potentially transferable to traditional markets as well. And so like getting into crypto now, like, if anyone is telling you it's risky, I would just say that they're uninformed, and that they haven't really seen the development and shift in terms of the institutional landscape that has happened over the past couple of years. Like pre FTX, post FTX, sure, after a year or two, people were scared. But now you have BlackRock's spot ETF, you have Apollo tokenizing their credit fund, you have massive amounts of liquidity in the space, you have all of these different, like, very smart people building. And so, yeah, from my perspective, like, if you're thinking about crypto, just go do it, like, get into it.
Facts, facts. Yeah. I mean, like that's what the blockchain club here is for, to get people internships. I know Chris through the blockchain club, so yeah, that makes a lot of sense. Yeah, and I feel like in crypto, a lot of opportunities are just like being at the right place at the right time,
Yeah, actually,
Yeah.
I've spoken to, a lot of people very recently, actually, over the past month, probably four, five, six, students, and then plus or minus 3 years of experience. So even people who are in the space right now. And one of the biggest things that I would say, not everything is like, flowers and sunshine, is there are so many opportunities in crypto to do things, but that also means that the opportunity cost is incredibly high for every opportunity you
Yeah,
take.
true, true.
If you spent 2 years of your life building on a dead chain, or you spent 2 years of your life at a protocol that went to zero or scammed people, that's 2 years of your life gone. And then if you think about the landscape and how that develops, well, now someone has just spent 2 years of their life at the best protocol possible, and they're going to get every single opportunity in the future, and you're screwed. And so the biggest thing to think about is like, okay, if you're choosing your career in traditional finance, like you can go investment banking, you can go consulting, you can do product management, you can go do SWE at big tech or FANG, you can go to a trading firm. All of that doesn't really have too much opportunity costs. Like if you go to investment banking, you could easily hop to a new role. If you're a quant trader at a traditional asset class at a traditional firm, you can go to a different role. If you're doing SWE, you can just go to a different role. But if you're in crypto and you chose the wrong protocol or the wrong chain and you want to stay in the industry, like you may be screwed, right? And so like you really, really actually do need to think, what role are you going to take as a new grad? And internship, it's a little bit less like, it's difficult to say like, oh, that was your fault for choosing that. And so it's a little bit more about just getting into the space and getting the experience and talking to the right people and networking. But once you choose that first role, it really, really matters what you chose. Because like I said, like if you spend 2, 3, 4 years at something that ends up being a scam, or ends up going under, or like it's a layer one that has no developers, or it's a esoteric language that nobody programs in, and you spent 4 years doing that, then it's like it's very difficult to transition if you want to stay in the space. So yeah.
Yeah, interesting. Yeah, that's true. That's true. Yeah, I've never thought of it this way. I guess like to end off, like, do you mind telling the audience like what are some places that you don't think are going under in crypto, like are worth starting a career in? Like what chains or what protocols, what
Yeah.
things? Yeah.
Yeah. I mean, I don't want to be too biased. I mean, obviously, Cumberland and Ergonia are great places to start your career. Obviously, Pantera, Dragonfly, like all the big VCs. That's something to think about, is just probably like do your diligence, right? Like go look at their portfolio companies, go look at their returns, go look at their historic track record. A lot of the stuff on blockchain is transparent, right? Like you can see the performance, you see the tokens they invest in, and you see what price they got in, and where they went. And so for me, I don't want to get too biased on like maybe I should honestly, like a lot of the stuff that I see, like Solana and Hyperliquid, I think that those are two of the biggest, chains and opportunities over the next 2+ years. I mean, if you're doing something on those ecosystems over the next 2 years, I can guarantee your skill set's going to be in demand at least probably 3, 4 years down the line. Don't want to say anything about chains that are unreleased yet or potentially that have been released and just have no activity. And so, yeah, the ones that are very clear to me where, okay, if you do this next year, you're still going to be able to do stuff the year after that would probably be Solana and Hyperliquid, or go the institutional route like I did whenever I first started my career, right? I had a friend who ended up at Galaxy. Myself, I ended up at GSR. I knew someone who ended up at DRW Cumberland. Like going the institutional side is relatively always going to be probably safe. Maybe not in 2022 or, whenever
fair.
people blew up. But now, like I said, like that risk feels a little bit lower. Yeah.
Interesting. Wait, so like what skills do do these institutional crypto firms want? Like, can you just name, like, I guess, top five skills?
Yeah. Top five skills. I mean, being able to think for yourself, be able to have opinions, form opinions, being able to have a more product, quantitative, technical leaning skill set would be nice and ideal. Hate to say it as well, but at some of these institutions, it really is just pedigree. So kind of just going to a great school like Cornell or Georgia Tech or Berkeley or Stanford, being involved in the blockchain club just because like those are so large now and are a great feeder into some of these opportunities. They give you the network connections that you need. I would also say, the other skills as well, just good, well networked, be someone that people want to work with. So, humble, friendly, the ability to learn, quickly and on the fly. Fact of the matter is, like, some people are still learning. And so the space changes very quickly. And so being able to be adaptable and flexible and wear many different hats, like that's something that is also beneficial. Yeah.
That's true. That's true. Yeah, I guess, yeah, one last question is, like the thing about institutional crypto or institutions in general, it's like it's very hard to break into. You know what I mean? Like after you get into it, you can jump around, but like it's very hard to get into it. I guess like, if you were a rising senior or rising junior in college, like what is one thing you would do to
Yeah,
get on?
go to the internships. So the ones that I know, Galaxy has a big program. Pantera, you obviously have a couple interns here. Masari, Delphi Digital, like all the research places that do internships, that's solid. You can also kind of like, carve your way into the space if you reach out to some of these protocols. Maybe work at a top protocol or a big protocol or even a bad protocol. I mean, it doesn't really matter. Just like get into the space, get interested. You're going to have some sort of way to differentiate yourself against candidates who have zero experience. Right. And so from my perspective, it's kind of like, yeah, a lot of these places, Coinbase has internships as well. Some of the exchanges have internships. But yeah, they're very difficult to land. And so it's kind of like that snowball effect. If you got some of this in freshman year, I would say that probably 20% of the candidates are going to have 80% of the offers. And so that's just the way it goes. And that's typically the way it probably goes in life as well. 20% of the people are going to be qualified for 80% of the roles, whereas 80% aren't even going to be getting interviews. So, yeah.
Yeah, it's fair. It's fair. Nice. Yeah, it is great having you, Chris. I personally learned a lot during this conversation, and yeah, thank you so much for being a guest on the
Nice.
Cornell Blockchain Chronicles.
Awesome. Happy to be here.
Nice.